You are listening to chartingwealth.com for Thursday, the 1st of March, 2018. We see stocks down, 20-year bonds are up, and we see gold down for the day. Now, we have some fascinating things happening with stocks. We'll get to that when we get to our 4-hour charts. We always start off with the S&P 500 and the weekly. What do we see on the weekly? Well, we have a candle that is slowly shrinking. It is smaller than it was yesterday. We look at the weekly candle. Remember, that represents 5 days of movement. We've just finished up Wednesday, so we are through 3 days. We have 2 more days of movement, but the candle is getting smaller. That means the wick on top is getting longer as the candle shrinks. Down again 1.10%. We see the price percent oscillator has kicked over like a hockey stick, going down again at a much more rapid pace. Derivative oscillator gaining downward momentum, even though we do see a green up box as we explore and get into things a little deeper. Look at that 2-day chart. We see that it has kicked over and started heading down. Derivative oscillator still losing downward momentum because we had an up candle on the prior 2-day chart ending on Tuesday the 27th. We have a red doji at this point. And again, this is just the first day of the latest 2-day candle, but it is showing that we have lots of indecision as far as that the prior up moves over the prior 4 days tending down, and particularly with the price percent oscillator kicked over and going down again. Now, as we plug into the 4-hour chart, what do we see there? Well, we see the telltale signs of things rolling over. Hasn't happened yet. May very well happen with that morning 4-hour candle. If the market bumps up in the morning and it bounces off the red signal line, then of course it didn't happen. But if it is a down morning and things start moving over, going down, remember, you are poised in every way to jump into a down move. Why? Because the 2-day chart is still in a confirmed down move, even though we've had some up movement over the last week and a half or so after the strong down movement for the week ending on the 9th of February, where we had, and again, I'm sorry, I'm showing you the 2-day chart. Let's look at the weekly chart where we had that strong down movement for the week ending the 9th of February. What happened after that is the market slid sideways for the past 2 weeks and then started going up as far as the average pace hike in Ashi candlesticks goes, but it started to stall and the price percent oscillator has flipped over. We talked about what the significance was of this huge down weekly candle for the week ending the 9th of February. It was like having a house on a solid foundation, which we had with the market moving up for weeks and months. And then your solid house has a bulldozer come in and kick out about half the foundation or more. Now your house is still sitting there, but you can feel it blow and teeter in the wind, and that was the problem. And of course, it is potentially systemic and potentially long-term. And as we see, as we plug into that 4-hour chart, things start to roll over. There may be an opportunity to capitalize if indeed this market is going to roll over again and head down. It's simply moved up since that weekly vertical crossover and sideways and up again. Now it's starting to move down, and if we do have the confirmation of a crossover, it would be something we would look to get into because we never got into the down move until that week was ended and we had the weekly vertical crossover. Remember, we're not forecasters, my friends. We are trend followers. And to be trend followers, you have to have the weekly and the 2-day moving in the same direction as the 4-hour chart after a pullback. And we have seen a pullback since the 13th. Since it actually started moving up on the afternoon of the 13th of February. And again, if it crosses over going down, that is our surest sign of continued down movement. Now, it could move over and go down for a little bit and pop right back up. That's not what it typically does, okay? Not what it typically does. So let's keep moving on. We got more charts to view. Look at the weekly chart on the Qs. Now the Qs is in a confirmed down move on the weekly chart, but it rotated back over and moved up on the 2-day. But currently we see that the price percent oscillators, actually, it was laminated when we looked at these charts yesterday. The weekly chart now for the price percent oscillator has moved over. The blue line's now below the red line. So that potential crossover has pulled back. Derivative oscillator heading down strongly. As we tune in a little deeper to that 2-day chart, it's still crossed over, going up, going into the second, tomorrow will be the second day of that up movement, which means that we really don't have a trade in the Qs because we don't have the confirmation we need with both our weekly and 2-day charts moving in the same direction. Nonetheless, we see that the price percent oscillator is moving up and the derivative oscillator switched over to green. As we look at the 4-hour chart, it does appear to be getting close to crossing over, going down. However, with the 2-day chart hanging out there still up, it gives us problems with sort of that schizophrenia between the 2-day saying up and the weekly chart saying down. So again, take that as it may. You can sure experiment, try things on your own, but again, that's not in keeping with our standard rules. But we want you to try things. That's why we are not a stock calling service. We're an education firm. We want you to practice trade every chance you get. Be sure to use the trade worksheets that we have because they help you form your trader's Bible. They help you keep up with your reasoning process, your thoughts, your getting in price, what you were thinking about, what the indicators were doing throughout the course of the trade, why you got out, and then what your profit or loss was and why. So make sure if you don't already have our trade worksheet, subscribe at chartingwealth.com. You'll get the trade worksheet, the weekly market worksheet, and the daily market worksheet for you to fill out every day. It forms your trader's Bible and is your historical record of learning. Very important. When you put pen to paper, that's when you really learn, my friends. Okay, that's where we are on the Qs. Going back to the weekly chart, moving along to TLT 20-year bonds, we can see that the 20-year bonds had broken through the weekly trend line so far this week. We have a green spinning top still up for the week. Derivative oscillator moving down. Is losing downward momentum. Price percent oscillator still moving down, but not at the same steep angle it had been. Again, TLT up 0.64% for the day. Again, that's 20-year bonds. We see that we appear to be getting closer and closer to a crossover going up on the 2-day chart. We've broken through the 2-day trend line and closed breaking through the weekly trend line on that 2-day chart. Derivative oscillators already switched over, going up. And as we look at the 4-hour chart, we've been talking about this since that 4-hour chart crossed over, going up all the way back on the 13th. Safest place to pull the plug on that trade because it was a beautiful down trade, was it not, my friends? We got in somewhere around the 126 point, 125, 50, something like that, and rode that baby all the way down. If you would have gotten out where it crossed back over going up at 118.60, what is that? That's about $8, $7. That's not bad. And again, for those who don't understand what we're talking about, how do you make money when something goes down? Either you buy a put, that is you short it, or you buy the inverse of TLT. There are inverse funds that track the 20-year bond. Now, the problem is the liquidity on those. You can have a big difference between the bid and the ask price. So again, practicing put trades would probably be more cost-effective for you to do. But again, just practicing getting in at the right point for the down move and getting out when you've maximized your profit or you have a pullback is and can over and over again be the best thing that you can practice. And then once you get good knowing, I can read this chart when it crosses over going down, when I get in, when I should get out. And again, when you've got the fluctuations in a 4-hour chart, not always best to pull out when that 4-hour chart rotates over. It did, of course, back on the 25th. That would have gotten you out way too early. What do you look at? You look at a combined arms approach, as former Marines like me would say. You want to use everything that you have out there in your basket. And, of course, using the 2-day chart to help you track down movement along with the weekly chart can, of course, also help you see things in a longer term. As long as you have red candles moving down on that weekly chart and the 2-day chart, it can mean that you can safely stay in longer. But when things start turning green on the bigger and bigger charts and you start violating your 2-day trend line and your weekly trend line, that's the time for you to pull the plug. Is there a hard and fast rule? No, my friends. If there was, a machine could do it. A robot could do it. A computer could do it. That's why you have to practice. Fill out your daily market worksheets. Learn how these ETFs breathe, how the stocks you're fascinated in work, how they work in every season. That's why you take your notes. You fill out your daily, your weekly market worksheets, your trade worksheets. You learn how to do this. If it were something a computer would do, then just computers would do it. And it's not that. It is an art in addition to being a science. That is where we are on the 20-year bonds. Want to make sure that we did look at that 4-hour chart. Of course, it has crossed over going up back on the 13th, then went flat again, moved back over on the 23rd, and of course moved up and down, and now it started moving up again strong for the day, 0.64%. Has not yet penetrated the weekly trend line on the 4-hour chart, but sure appears to be getting close to it. Derivative oscillator gaining energy, price percent oscillator moving up. Now moving into the last chart, what do we see with gold? Down 0.10% for the day. Looks like that weekly chart is moving closer and closer to crossing over, going down. It may do that by the end of the week. Remember, the 2-day chart's already down. Weekly chart is still up, but getting close to crossing over. Price percent oscillator, not yet crossed. Derivative oscillator losing upward momentum. As we look at the 2-day chart, we can see that we've got now 4 candles connected representing 7 days of movement. It's just the first day of this latest 2-day candle, but strong down movement. And of course, that 2-day chart is already in a position since it crossed over going down all the way back on the 7th of February. Weekly chart still trying to hold its own there in gold. We see derivative oscillator gaining downward momentum, price percent oscillator gaining downward momentum on that 2-day chart. 4-hour chart, is it flattening? It really reached a lower low back on the afternoon of Tuesday. Up some in the morning on Wednesday, down some in the afternoon. We want to see that 4-hour chart really start trending better so we can start counting on it again. But we'll just sort of keep our eye on things and see if by the end of the week gold rotates over going down on that weekly chart. Folks, that's where we are as we end the day on Wednesday and go into Thursday, the new month, the 1st of March 2018. God bless. Love to hear from you. Please, if you're not already a subscriber to our channel, go and do that. You get all the bonuses there. Plus, you'll also see the discount that we offer you if you wish to go from freestockcharts.com, which is the layout we use, and we have a free layout there for you that you can use at freestockcharts.com. When you're ready to go to the next level and subscribe to TC2000, we have a discount of $25 for you if you use our link there that you'll receive with your daily market email. It's going to be in that email that goes out every day. How do you sign up for that for free? Go to chartingwealth.com, put in your name, your email address, and you'll be getting everything we have to offer along with the daily, weekly, and trade worksheets. God bless, my friends. All the best from the entire team here at Charting Wealth World Headquarters.